Well, hi, and welcome to our semi-annual State of the Market Outlook for 2021. For those of you who have been with me a while, we do this every 6 months, and sometimes we're lucky enough to do it in person. We are fortunate again this year to have Tony Parrish join us. For those of you who don't know Tony, I know many of you have met him. Tony is the Chief Investment Officer of our investment leg, which is Alpha Star Capital Management. Tony, welcome, and thanks so much for fitting us in your busy schedule. I know you're booked these days.
Thanks, Dave. It's great to be here.
Yeah, what I'd like to do for those of you who are listening and for you, Tony, is we've put together this market outlook. It's going to take probably, I would say, about 10 to 15 minutes. I'm going to run through these slides and give everyone a general outlook of where we were with 2020 and where we expect to be in 2021. For those of you listening, what I'd like you to do is, as I'm talking, just make little notes of anything you hear tonight that is of particular interest or concern to you with respect to your retirement plan or your investment strategies. If you have anything written down at the end of that talk, and we'll mention it again at the end of the evening, get on the phone to my office tomorrow, get on my schedule, and let's one-on-one talk about how the things we discussed tonight affect your specific plan. Because what Tony and I are going over today are going to be generalities, right? You never want to take a general statement and apply it to a unique individual situation like you all have. Would you agree with that, Tony?
Absolutely.
Super. So we're going to jump right into this. Megan, if you'll get the PowerPoint running, and we'll get started. Okay, so here's where we're going to start. We are going to give a quick overview of a 2020 recap. We're going to discuss the pandemic and the recession that followed. We're going to talk about where we are with record stock prices, the government stimulus that we've had so far, and market winners and market losers. From there, we're going to go on and we're going to talk about our perspective for 2021, specifically the new administration, the Biden administration, 2 investor themes that we should consider moving forward, the perils of market timing, and then 2 alternatives to market timing. We're going to start with the 2020 recap. So, as you all know, 2020 cannot be discussed without the pandemic and the recession that it introduced. In the U.S., the pandemic eliminated, get this, 5 years of economic growth, knocking the U.S. economy back to its 2015 levels. Subsequently, several segments of the economy have bounced back, with some actually climbing to new heights. However, the impact of the pandemic is likely to last for several more years. And yet, despite the global recession, what we have seen is that the stock market has reached all-time highs. Now, why is that? Well, I would suggest that monetary stimulus resulting from Fed policy, which is providing liquidity into the capital markets, is fueling that stock market rise. In 2020, the Fed's balance sheet surpassed $7 trillion, that's trillion with a T, $7 trillion, a number unthinkable even as recently as a year ago. Now, the fiscal stimulus enacted by legislators has also helped to buffer the economy. The fiscal 2020 deficit rose as a result of this by $3 trillion. So when we look at the combined government stimulus in 2020, it's clear that this represents the single largest transfer of wealth, and I mean transfer from the public to the private sector in U.S. history. So the activity of the 2020 stock market can be explained by a historic drop induced by the pandemic. We saw that in April, and a historic rise fueled by government stimulus. Clearly, in early 2021, the markets are expecting more stimulus still as we are awaiting the next Biden stimulus package. So, what can we learn from the stocks in a recap? All of the major stock segments appreciated during 2020 for the reasons we just discussed. However, large cap growth stocks led the way. as many companies benefited from the changes in consumer behavior. An example of that would be Amazon. Once again, in 2020, as has been the case for most of the previous decade, growth stocks outperformed value stocks. Now, technology stocks delivered exceptional returns during the previous year. Among the stock sectors that we looked at, and you can see them listed here, you also note that energy sector performed the worst. Looking at the S&P 500, what you see here is even though the S&P 500 came roaring back after the first quarter, it's important to realize that this recovery of the S&P was very heavily concentrated in a very small number of companies. You see here on this graph that the top 5 companies, Apple, Microsoft, Amazon, Alphabet, and Facebook, these top 5 companies, all related to technology, make up nearly a quarter of the index. Meanwhile, you see on the next portion, 8% of the stocks in the S&P 500 make up 1/2 of the index. So you're seeing that increasingly the fortunes of the S&P 500, the ups and the downs of the S&P 500, are driven by a very small number of constituent stocks, particularly in the technology arena. So as these tech behemoths go, so goes the S&P 500. Now, what that also shows us is the returns of the index are even more concentrated. In 2020, the total return for the S&P 500 you see here was 18.4%. We talked about this a moment ago. Meanwhile, the 5 largest companies, Apple, Microsoft, Amazon, and Alphabet, they made up, get this, 14.35% of that 18% growth. What that means, folks, is that the remaining 494 stocks combined to deliver a return of just 4%. So when we talk about the S&P 500, you could call the S&P 494 a stock of the largest U.S. stocks, excluding the ones we just talked about, only grew 4% this year. Whereas if you had just bought Apple, Microsoft, Amazon, Alphabet, and Facebook, you'd have grown 14%. Okay, so what do we see with interest rates and bonds? All around the world, not just the U.S., interest rates dropped as investors chose safety over income. While Treasury yields in the U.S. hit their all-time lows, those same yields that we're seeing in the U.S. look very attractive relative to other countries in the developed world. And what you see here is, Japan is literally at 0 interest rates, and France is at negative interest rates, as is Switzerland. So that's our highlights, our recap of 2020. Let's talk about the perspective for 2021 and moving forward. First, the market impact of the Biden administration. What does a Biden administration and a Democratic-controlled Congress mean for the capital markets? Well, relative to the Trump administration, investors could see more emphasis on wealth inequality. And Tony and I, we're going to discuss this a little bit after the PowerPoint presentation. We're going to see a focus on higher taxes for top wage earners and corporations, less fossil fuels, more renewable energies, additional regulation of financial services, and a possible push for infrastructure spending. Now, markets know and are comfortable, this is great news for the markets, with Janet Yellen and Jerome Powell, who are heading up Biden's financial boards. However, there are some important considerations that should be noted when we're discussing the Biden administration. First, Democrats have a very slim majority in Congress. Of course, that we know is 1 vote. What that means is they're going to probably have a lot of difficulty moving any unpopular proposals through. They will not survive. They're not going to have the votes for it. Another thing is beware of any recommendations you hear about from the economic pundits. You see here in 2016, commentators said that the sectors outlined on this PowerPoint should do very well under the Trump administration. In hindsight, what we saw is over the last 4 years, they were among the worst performers. Number 3, evolution of the pandemic and government stimulus will have a far greater effect on the markets in 2021 than in the new legislation. Now, what are some of the investor themes moving forward? Well, the first big investor theme for 2021 is the direction of the economy. US GDP will likely expand by 2 to 4%, which seems like a reasonable prediction moving forward. However, growth is contingent on a containment of the virus. So this recovery is still very fragile, and there is still the possibility of what we call a double dip recession. In other words, progress is encouraging, but risk still remains. There are a lot of unknowns with respect to the virus and the vaccine. The other thing that we see is that stocks historically are expensive. The second theme where we're talking about, I want to focus here, is on stocks. A look at these charts show that stocks are either more expensive or at least as expensive as they have ever been in the last 2 decades. Now, that seems counterintuitive, doesn't it, considering the fragility of the economic environment? Stocks could very well continue their upward climb as we continue to see stimulus, low rates, and an accommodative monetary policy play out as the markets expect. So we're already right in the midst of seeing this next stimulus package promised by the Biden administration that right now, tentatively, we're looking at close to $2.1 trillion. That's what they're talking about here, is that if we continue to get this stimulus money flowing into the economy and we continue to get an accommodative monetary policy, then the market could continue to run up. But there still continues to be a level of risk because we are at all-time highs. Many investors attempt to time the market. That's not unique to anyone, right? But what they try to do is react to market movements. But this, too, induces its own type of risk. Let's use last year's stock market path as an example. If investors held the S&P 500 for a full year, they would have realized, as I mentioned before, a gain of 18.4%. Now, that's easy to say in hindsight, isn't it? However, if they got spooked and they sold after a 20% drop and then bought back after the market had a 20% bounce, the return would have been closer to 6.6% versus the 18.4. Now, one of the takeaways there, right, is that in hindsight, we know exactly what to do. There's no promise to how this thing's going to recover. So what it does tell us is just randomly trying to time the market can often backfire on you versus a buy and hold strategy. Now, buy and hold has its own perils, right? The alternative to market timing is, again, what we've all heard of as buy and hold. Choose some investments that you like and hold them for the long term. As this chart shows, on any given month, if you had invested in the S&P 500 looking back at any month over the last 50 years, you can see that there was almost a 40%, we're looking at the top of the graph, a 40% chance that the index would lose money if you only held the S&P for 1 month. If you held for 3 months, it dropped to about a 33.9% chance that you'd lose money. At a year, you had a 1 in 4 chance of losing money. If you were going to hold those holdings, the S&P, for 5 years, you still had a 20% chance or a 1 in 5 chance 5 years later of losing money in the market. If you're going to hold that S&P for 10 years, your chance of losing money drops down to 8%, just shy of 1 in 10 chance. And what this chart shows is if you wanted, based on historical data, to have your best chance that you did not have risk in the stock market, you need to be willing to put your money in the market and leave it untouched, no matter what's going on in your life, for 20 years. So the takeaway for me there is that the buy and hold strategy absolutely works, but you need to be willing to hold for very long periods of time, assuming that there's a market correction. For most of you listening today, we've built out your plans so that you have alternatives available to you so you can let your money in the market recover for longer periods of times. We'll discuss that a little later with Tony. So in some ways, 2020 has provided us a good, think of it as a fire drill for the stock market. So we can look back at the lessons learned in 2020 and ask ourselves, if the market plummets again, just like they did last year, will my portfolio be ready for it? If you're not sure of that answer, get on the phone tomorrow with Michelle or Megan in my office, get on my calendar, and let's talk about how we would expect your portfolio to perform if what happened last year happens again this year. So here's our summary. The pandemic threw the world into a recession. The economic recovery is encouraging, but still very fragile. And yet stocks are at all-time highs. So this was largely driven by government stimulus, the magnitude of which has never been seen. We're expecting more government stimulus in 2021. The Biden administration will introduce some new legislation very shortly. We're looking at, although it's not decided yet, $2.1 trillion. But the evolution of the pandemic, and this is a key point, we believe that the evolution of the pandemic and further stimulus will be much more consequential to the markets than any legislation that we see from the Biden administration. Next, investors may be tempted to time the markets, but this introduces just a different risk than you have with the buy and hold, which is the risk of having to hold for a long period of time. So take 2020 as a fire drill for what could happen moving forward for 2021 and beyond. And if you're not sure how your portfolio will perform if this happens again, or if you want to make some tweaks, get on the phone, get on my calendar, and let's discuss it. Long hold time, diversification can mitigate portfolio risk, but only the key there is long hold time. Okay, with that said, I'm going to ask Tony to join us back. Tony, did I give us a good summary of what we've worked on?
You did a great job. I thought it was a great summary. I especially think, investors should not lose sight of the fact that we tend to read a lot of headlines about what to do with our portfolios and what different, exciting topics may impact the portfolios. The big picture, though, is stimulus and the pandemic are the two biggest factors that will determine how the capital markets perform in 2021.
I agree. And that's why I think it's so telling, as when we were doing this, we discussed that we can look at 2020 as a fire drill, right? Because if the vaccines don't go the way we're hoping, or if they don't respond to these, I'm not the medical guy, but the variants in the vaccines, right? We could very well have a repeat of what happened in 2020 with a double dip recession. So we want to be prepared for that and be willing to live with our expected returns based on how our portfolios put out. Would you say?
Absolutely. Make sure portfolios are set up to accomplish the goals and yet can also weather a storm if a storm were to occur later in this year.
Yeah, and we talk about that a lot with the folks that are listening today, Tony, which is how much downside, how much risk are you willing to accept if things don't go as planned?
Right.
We do that with everything in our life, don't we? It's why we decided to put a life preserver on the boat, where there's only so much risk we're willing to take, and we want to do the same thing with our plan. It doesn't mean we completely avoid risk. There's no way to do that. Right, but we can try to mitigate risk using data and fact to build a plan that's in the client's best interest based on your risk tolerance, which may be different than your neighbor's, right? And the quality of life you're looking to enjoy moving forward. So, Tony, with that, I want to jump into a few specific slides. And the reason I picked these out, these are slides that interestingly have generated the most questions. That's why we added them to the slide deck over the last 2 or 3 months as I've been working with clients individually. So let's kind of go over these, and I want to get your take on some of these questions. So if you recall this slide, it talks about the market being at all-time highs, right? Well, several folks that we deal with have quite a bit of money that right now is still sitting in cash, but they're gun shy. And we've had these discussions about, do I get in now after literally an 11 or 12-year up market? I don't want to be the guy that buys into the market at an 11-year up, right? And then the market crashes 40% and takes me, from we saw from the other graph, maybe 10 years to get even. So what would be a strategy for someone with money in cash that they've already allocated, that they ideally want in the market? They're just gun shy of being the guy to buy in at the last minute.
Yeah, it's a great question. Money is personal, right? We can look at all the slides and charts and graphs and historical data in the world, and yet at the end of the day, that's just an academic abstraction relative to the money we have in our accounts. So we have to make decisions that are specific to the individual. And for those individuals that are sitting in cash, knowing that they really need to put their money to work to be productive during their investment time horizon, for those people, I would say there are two approaches. One is to either use a strategy that is managed in such a way to participate in market upside while protecting against catastrophic losses. There are certain strategies, Dave, that I know you're aware of, such as Beta Shield or Navalier Defensive Alpha, et cetera, that really are set up to do just that, participate in market rallies and protect against catastrophic losses. That's the first approach. The second approach is for strategies outside of those that are actively managed to protect against losses. The second approach is really just to use dollar cost averaging to systematically invest a certain portion of the assets into the market over a period of time. So you may do it over a 12-month period, you may do it over a longer period of time, but essentially, if you wait on the sideline, especially in the era of unprecedented stimulus, you could see the market continue to run away just like a train that you missed. Alternatively, if you put it all in today, we are in a situation where the markets could absolutely have a repeat in terms of the downturn that they experienced in 2020, and you would be buying in at high levels and experiencing that painful loss. So one way to mitigate that is systematically invest a portion of the money over a period of months or quarters until you ramp up to that full investment period and you take advantage of the average cost over that period of time.
Okay, good. So the takeaway, if you're listening today, if you've got money sitting in cash that ideally you've got set aside that you ultimately want in the market, right? Get on the phone, get with me, and we can discuss these two ideas. One is the long-term buy and hold strategy, and we would do dollar cost averaging maybe over the next 12 to 24 months to get you invested. And then the plan would be to stay there on the long term. The other option would be to move into a model specifically designed and monitored to limit your downside if the market starts to go down. And we've got several, in particular, the Beta Shield models. There's several of them that are specifically designed to minimize the downside from a major economic collapse. And the advantage to that is that we would recover quicker in theory. So you wouldn't have to wait, for example, 10 years to recover. In theory, you might recover in half of that time. That's the idea with those type models. The Navalier Defensive Alpha is another one that's designed loss mitigation. Those you wouldn't necessarily need to dollar cost average in. And that way, if we were, because of the stimulus that's coming, if it generated a 7 or 8 month period of extended up, then models like the Beta Shield or the Defensive Navalier would participate in almost all of that up as opposed to the dollar cost averaging. So one's not better than the other, they're just different, correct?
Correct.
The secret is for each of us to get together when we're meeting and let's decide which one's the best model for you moving forward, which strategy is the best model. Now,
there's more than one way to skin a cat, as they say.
Boy, that's it, right? And it's different for different cats.
Right.
Let's look at this slide. This one was interesting, and I talked about it a little as we went through, because in my opinion, and I know that Alpha Star doesn't do this, but I consider this a huge problem with the financial industry, that the pundits and a lot of, frankly, financial advisors use the buy and hold strategy as a technique to tell folks, go in the market and just stay, because buy and hold works over time. Now, boy, is that tricky, because the data says that's exactly true. And the data that we've looked at together, Tony, even says that, over long periods of time, then buy and hold is better even than some of these loss mitigation strategies like defensive alpha or beta shield. But the devil is in the details, isn't it? And what we see from this chart is that to get that kind of performance as close to guaranteed as we could, based on past data, you have to be willing to leave your money literally untouched in the market for 20 years. Even if you're willing to leave it 10 years, you almost have a 1 in 10 chance of 10 years later having no gains or negative gains. So buy and hold works. If you're 30, you've got a 401k and you're not touching that money for 30 years. But if you're 50 or 60 or 70, then you have to ask yourself, the portion of the funds you have in the market, based on this data, am I willing to sit long term if the market corrected tomorrow and stayed down over longer periods of time? So my question for you, Tony, would be, if we're specifically talking to folks that are 60 and above, near retirement or in retirement, looking at this graph, what jumps out at you, and what would be some suggestions for you for those clients?
Yeah, so thanks for that, Dave. I am a student of the capital markets. I love to study the markets and infer patterns and make observations based on that. That 10-year number, if you held for 10 years, you had an 8.5% chance of losing money. You're right, it's just less than 1 in 10. Let's use a specific example of why that's important. And I think of people that were retiring right around 2009, 2010. Because what that meant was they actually had 2 recessions in their 10-year window leading up to retirement. They certainly had the financial crisis of 2008, but they also had the dot-com bubble burst at the beginning of 2000. So if they were unlucky enough to be retiring in 2009 or 2010, their portfolios they had the 1-2 punch of 2 recessions. Good news is with this recession, we have not actually seen an impact to portfolios, despite the fact that we're in recession currently. Why is that? Stimulus, right? Yeah, I mean, you went over those slides well. Monetary stimulus and fiscal stimulus, and we're expecting more. So the thing that stands out here is nobody knows what the future holds. Nobody has a crystal ball. And that's why it's so important to work with financial advisors such as yourself to make sure that you establish the plan, the financial plan. You do that in the calm, cool light of day when it's 72 degrees and mostly sunny outside. You don't do it in the middle of a storm. You prepare for the storm when the weather is nice. And you make sure that you come together and determine what is the right strategy, what's the right portfolio, and what is the hold time, the investment time horizon. And based on those things, you then have a reference point to be able to go back and use when the storm hits to know that you've established this plan that's particular for you. I really like your approach, Dave, of looking at the markets and working individually with your clients. I think that more advisors would do well to take your example in terms of best practices for their clients.
Yeah, I appreciate you saying that. I think the one takeaway for folks listening today, if I had to disagree strongly with what I hear often in the financial community, is any inference that there's a cookie cutter strategy that anyone should adhere to that works or doesn't work, I strongly disagree with. The The reality is every plan should be unique and different based on your risk tolerance, your timeline, right? And really your goals in retirement. And that's different for everybody. So this idea that you should at 60 have 40% in bonds and 60 in stocks, to me is nuts, which is a challenge, frankly, I have with these target date funds, which is a call for another day, right?
Right.
The takeaway is, and this is why it's just such a joy to work with the folks that we work with, is they get it. That if you want to do this right, my dad used to tell me this, Tony, there's two ways to do things, quick and right. Right? And right sometimes takes time and effort. And that's what we do. We work with everyone individually and work out their particular plan, and it's unique to everyone else's. So for those listening, you shouldn't be surprised if you've got a plan with us and your neighbor does, and they're completely different, right? They may be willing to take more risk or less risk. They might need the money sooner or later. Every plan's different, so you're not going to see cookie cutter. And whether you're using me or someone else, that would be my big takeaway. But Tony, a couple more minutes, if I can take your wisdom. What
I'll do my best.
You know, we talked about all that could go right this year, namely stimulus, a very accommodative program by the Biden administration to keep moving the economy along. I believe that's priced into the market, right? The vaccine working, all that happens. I think it is very likely that the markets could continue to roll forth at least through the third or fourth quarter. Let's be a devil's advocate, what are some things that are risks that could put us into a double dip recession, right? Or take a wheel off that wagon?
Sure. Well, so there are known unknowns and there are unknown unknowns. There's always stuff out there that we just can't foresee that could take us down. Nobody foresaw COVID-19 at the end of 2019. Nobody foresaw the terrorist attacks of 9/11 20 years ago. So there are always things that could happen that are just not on anybody's radar screen that could have massive impact on the capital markets. But that's always the case. Let's set those aside and focus on the things that we know that could be wild cards here. The biggest one from my perspective is that a year from now, we're essentially in the same vulnerable situation with respect to the pandemic that we are today. How could that happen? All these variants pop up. The vaccines are less effective on the new variants than they were on, the major strain that we saw last year. Yep. If that's the case, depending on how nasty and pernicious these variants are, further economic lockdowns are not out of the question. I don't think that that's our base case scenario. I think we're making a lot of progress in terms of, the medical community and how we can effectively contain the virus from a behavior standpoint. We've made a lot of progress over the last year, and that'll benefit us. But it is certainly a possibility that the pandemic ends up being, having more uncertainty and uncertain developments than we currently know about. And of course, the other thing is that, we have such a close and divided legislature right now. It's possible that further discussions about stimulus really get quashed. And what the markets are, I believe, currently pricing in is a reasonable likelihood that we're going to have $1 trillion to $2 trillion of stimulus coming down the pike. If that becomes argumentative, and the stimulus ends up being much lower than that or not at all, depending on how long this draws out and how much the economy recovers, a significant change in the stimulus projections could have a major impact on how the capital market pricing mechanism works. Stocks could correct because they are currently pricing in an expectation of high stimulus, and if that doesn't come, stock prices will adjust accordingly.
Yeah, and how about this too? This is a big concern that comes up. Let's just say that the stimulus does go through at that $2.1 trillion number.
Yeah.
There's an argument that we're just kicking the can down the road another 9 months, right? So folks get an extra $1,400 check, right?
Yeah.
That's helpful, but certainly not with the markets. They extend the unemployment subsidies as much as $600 a week for another 6 to 8 months till September or October. They continue with the rent and mortgage eviction and foreclosure moratoriums for another 4 to 6 months. Well, eventually, right? Eventually that stuff has to stop. And then it's kind of like those old, I'm dating myself. Remember the old days when you got a bottle of pop and you put your thumb on the top and shook it, right?
Right.
It's turbulence, but as long as I don't remove my thumb, the outside world is completely blind to the turbulence inside the Coke bottle. But sooner or later, I got to move that thumb. And that's what we have a concern, right? Is we're going on, a lot of these people maybe haven't made a mortgage payment since April, right? Same with some foreclosures. Well, as soon as that moratorium goes away, a lot of people forget those aren't forgiveness, right? If they couldn't make a monthly payment, they're not going to be able to make 10 or 12 months of back payments. So sooner or later, right, we got to face the music with all the stimulus. And I would argue that although everyone's been surprised with the amount of stimulus over the last 12 months, including this coming 2.1 trillion, we can't keep printing money forever to keep this train going. So I think we saw evidence of that in September, right, when the market started to dip. And the reason we did was a lot of these economic stimulus things expired, right? And then what happened is the president stepped in with a stopgap 2 or 3 month issue and the market jumped right back up. So to me, that is very telling, Tony, that as long as we're getting free money, the party continues. But the minute the new free money stops, then we could expect at least some kind of a correction.
Absolutely. The stimulus is really there to buy time, not to solve the problem. The problem is lack of organic economic activity. So we can buy time and we can kick the can down the road, but ultimately we have to get back to the level of true economic activity that we had been on pace to achieve prior to the pandemic, and that activity was derailed by the pandemic. It's really a race, right? I hope, and everyone hopes, that true economic activity can pick up, that the labor market can truly recover and get back to full employment, that we get the velocity of money going through the economy again, because what has kept us going is stimulus, but all that does is buy us time. It doesn't actually fix the problem.
Yeah. So again, the takeaway would be when we were talking about building your portfolio, right, is eventually, because it's happened since the beginning of time, the markets never go up forever, right? We can discuss all day what's going to cause the next correction and when it's going to be, but it will come, right? We can't go up forever. So what we really want to do is have that one-on-one discussion of when it happens, how much are you willing to ride out and for what period of time, and then we can make an educated decision as to how to position your portfolios. One more here for you, Tony.
Sure.
We mentioned when we're talking about the Biden administration, because we're seeing a trend, not really, to me, it wasn't about Biden's administration. We have seen this for the last 12 years moving. It's like a storm coming if you don't like higher taxes. It was postponed by 4 years with the Trump administration, but we have seen this, in my opinion, this concerted move to a socialist democracy like you see in Europe, which means higher taxes, right? It started with the Biden administration and it went on hold, and then, the Obama administration, and now Biden has picked up and they're talking about things like a wealth tax for the ultra wealthy on their assets. We're talking about, of course, raising taxes on the top wage earners, and usually my experience has been that over time trickles down to the middle class taxes. But the data is clear. We are at historical low interest tax rates, right? We have never had so much debt, barring World War II. So I believe, and many of our clients have talked about this, there is nowhere for taxes to go over the long period of time, the next 10 to 20 years or 30 years of our clients' lives, but for taxes to go up. You're starting to hear terms like wealth inequality and how to solve those type of situations. And the answer, if you read these opinion op-ed pieces, they always around the same thing: raise taxes on folks and we can redistribute the wealth. So what do you see as being a risk towards clients 55 and up?
Yeah, I certainly think that the pressure on taxes over the next 10 years is higher, not lower. I think that using the terms socialist democracy like Europe, for instance, I think the United States proudly has a different cultural relationship with taxes. So I'm apprehensive to use a term like that to describe what I believe will happen in the U.S. Tax environment over the next 10 years. But if I were a betting man and I would try and determine what's the most likely path of tax rates, I'd say that from here over the next 4 years or 8 years or 12 years, we're probably talking about something that looks closer to the way tax rates were during the Obama administration as opposed to the way they are now. In other words, corporations paying more, higher earners paying more, more of a focus on kind of redistribution of wealth, right? Taxing the higher earners in the corporations and using some of that, some of the money that goes into the federal coffers to pump into programs that can benefit the less fortunate, the lower earners, et cetera. So listen, that's why we have elected officials, right? The elected officials duke it out and try and establish legislation, including tax policy. And if the constituents are not happy, every 2, 4, or 6 years, depending on which elected official in question we're talking about, every 2, 4, or 6 years, the constituents have the chance to make a change. So this tax argument will continue for the long term. I expect tax rates to have pressure upward over the next 4, 8 years, not downward. But I also don't think we're going to be. I don't think we're going back to the tax rates of the Eisenhower administration, where the highest marginal tax rate was over 90%.
Mm-hmm. Yeah, but I agree with you. And I'm with you. I think we are blessed, the country that we're in, that we wouldn't make it to that socialist democracy that we were kind of talking about. But even looking at tax rates here in the U.S. is, going back as just as far back as the 80s, right? We are in historically low tax rates. So one of the takeaways, and this has nothing to do necessarily with the market side, right? But as the comprehensive planning side, if you're listening to this and you're betting on taxes moving up over the balance of your lifetime, understand that one of the paradigm shifts in the market planning for you all is going to be tax efficiency. And we've got investment strategies with Tony's team that are tax efficient. And then we've got specific strategies to minimize over time the taxes you will pay in your retirement accounts over time if we're betting on a higher tax rate environment. And more, just as importantly, dramatically reducing the taxes that are incurred at your death if you're interested in passing on some of this money to heirs. Now, if you think taxes are going to stay the same or go down, don't worry about this part. But if this concerns you, get on my calendar and let's specifically address how to rearrange or tweak your plan to try to minimize taxes in a rising tax environment. Tony, I think that's all the time we've got. Otherwise, you're going to send me an invoice, and I don't want to get an invoice for an extra charge. I can't thank you enough for being with our listeners. I know that it means a lot to have you on the call instead of me, hearing the words from you. And I look forward to doing this, every 6 months. And I really look forward to us doing it again in person like we did last year. Tony, thanks for joining us. For those of you at home, thanks for listening. And I look forward to talking to you. Do not hesitate to get on that calendar so we can look at what you heard today and how it affects your calendar. Tony, any final words?
I'm happy to be invited to the party, and I look forward to next time. Hopefully we will be able to do it all together in one room. Thank you.
God willing, and the creek don't rise, right? Thanks, and we'll talk. I look forward to talking to each of you soon.